As ever, we're delighted to be joined by the Chief Investment Officer, Viola Private Wealth, Daniel Kelly. Very good morning to you.
Thanks for having me again.
Let's explore the march and the rise of passive investing. How do you think it's influencing wealth portfolios, both within your organization, but more broadly?
Well, Warren Buffett's been trying to tell us about this for decades, right? He's been telling investors to buy and hold the S&P 500 and that will do plenty fine. I think a lot of the time, advisors feel like they're going to come across as lazy if they're putting passive indexes into a client's portfolio because they almost feel compelled to use active management in every single segment because that's their job as an advisor. The approach that we take at Viola is we have no issues with using passive indexes. We just know where and why we're using it. And so I take the philosophy that, the larger mega cap segments of the market are typically quite efficient. So efficient market hypothesis kind of states that most information is priced into stock markets. Therefore, our performance is difficult over what is already kind of reflected in intrinsic values. So we use passive management in the larger mega cap segments, and we use active management in the small and mid cap segments where managers can much more reliably produce alpha and justify their fees. We kind of construct our portfolios in a way that reflects the most recent trends. And it's quite easy for me to sit and talk to you about doing this because I do it with my own personal money, right? And I think that idiosyncratic stock risk, particularly with how quickly the waves of disruption are coming from artificial intelligence, means that it's never been more difficult to price the future of a business. So, 6 months ago, no one had heard of Anthropic, and now everybody's using Claude, right? That's a really good example. So we construct portfolios in a similar way, and we're noticing that trend from kind of more of our ultra high net worth clients that we're talking to. The family office clients are wanting us to take that same approach and saying, look, we've read the most recent Spiva report. It read like last year's report. Next year's report will probably read the same way, whereas 90% or more of active managers regularly underperform their benchmark. And so we want to steer away from that. We do a lot of work in identifying quality active managers, but we're mainly using them in the smaller mid-cap segment.
And from that CIO perspective, Daniel, what are you looking for in terms of where you're going to deploy something like passive? Is it the liquidity profile of the asset class? Is it correlations? Is it your fee budget and trying to think holistically? What are some of the forces that allow you to have the blend that you've constructed?
Where we weight certain indexes or geographies primarily comes down to GDP and inflation. GDP is really the main growth driver behind what the index will do. So there's a nice formula in the CFA, and basically, I won't go into it, but mathematically, everything cancels out except GDP, right? So the growth of the country obviously dictates how much corporate profitability there can be, and the private share of public earnings, right, can kind of increase, decrease, and the PE ratio can kind of vary as well. But long-term GDP is really what dictates market performance. We actively manage a passive sleeve. And what I mean by that is we're not just, putting all of a client's money into the S&P 500 day one and just leaving it, right? We deliberately, and Charlie and Pete and Alex and Daniel, all of our advisors do a really good job at keeping some powder dry, because particularly in an environment where we've got Trump as the president in the US, there's going to be regular opportunities to deploy into weakness. So if you actively deploy into periods of stress and weakness into a passive index, you can create alpha. So with the Liberation Day sell-off, from the trough that the index hit to where it ended up at the end of the year was about a 45% rally, even though the S&P 500 only did about 16% that year. So if you were strategically deploying into that period of weakness, obviously having a look at the macroeconomic environment, having a look at whether or not you should be going into that or being a little bit more patient is important. But yeah, being active with a passive sleeve can create a lot of alpha. And then also it's during periods of stress that markets can rebound and rally a lot faster than they used to. And I think it's primarily the participation of retail money. I call it the Robin Hood effect, right? It's not just institutional money and hedge funds that can deploy vast amounts of money into markets now. And so because of that, you may not have the luxury of time to dust off your analyst reports and determine whether you're buying Tesla or BYD. You need to act quite quickly. What's the best way to do that is a broadly diversified passive index.
Let's just explore one asset class in particular, also one segment of the portfolio. Fixed income, that ability to generate yield, but reduce your fee budget potentially. Is that something you've done some thought on? What are your views on how indexing can be deployed here?
We don't use any passive exposures in the fixed income segment. And so we took that approach to the way that we build our fixed income sleeve at Viola. We have no passive exposures in the fixed income sleeve. There's also a problem with market cap weighted fixed income bond indexes because it can upweight those companies that have higher amounts of leverage, which is not necessarily what you want. And it's not exactly the same type of measure as, say, market cap, weighting methodology for equities. So yeah, no passive exposure in our fixed income allocation, but we have trimmed fixed income in favor of investment grade private credit. But across kind of our fixed income and private credit sleeve, we're still probably doing about 15 to 20%.
It's always a pleasure to learn from you, Daniel. Thanks for your time.
Thanks a lot.